Hello learners, welcome to Commerce Diction. Myself Riya Das. In the previous class, I have discussed about the difference between direct tax and indirect tax. If you have not watched the previous class, please do watch it, like, share with your friends and don't forget to subscribe to get notification of all the classes. In this video, I am going to discuss about the types of direct tax. So first is the income tax. Income tax is a tax on income, gains or profit earned by a person exceeding the specified threshold limit and other artificial entities. It means income tax is a tax which is chargeable on the income of a person or on the profit or gains earned by any artificial entity like the business or any professions. Then that tax is called as income tax and it must exceed the specified threshold limit given by the government. Okay. Now next is the wealth tax. Wealth tax means tax on the wealth of a person. Now what is wealth? Wealth means any property or any type of jewelry, or we can say any precious stones or any of the assets, we can say, possessed by a person, example individual, HUF, company, except non-profit organization and cooperative society. So if any wealth are possessed by any of these persons will be taxable. Now this tax was abolished in the year 2015. It means now the wealth tax is not in existence, but it was there before the year 2015. Now next is the gift tax. It was introduced by government in April 1958, regulated by Gift Tax Act 1958 with an objective to impose tax on gift in the form of cash, check, immovable property such as land, building, movable property such as shares, jewelry, etc. However, it was abolished in 1998 and made gift tax free. It means it was first introduced in the year 1958 and was regulated by Gift Tax Act 1958 with an objective to impose tax on gift. It means if any gift is received in the form of cash, check or any immovable property such as land, building or any movable property such as shares, jewelry, precious stones, then that gift were taxable under the Gift Tax Act 1958. However, it was abolished in the year 1998 and made the gift tax free. It means before 1998, any gift received in the form of cash, check or land, building or any shares, jewelry, etc. were taxable, but after 1998 it was made tax free, but it was reintroduced in a new form and included under Income Tax Act 1961. It means gift tax are included under the Income Tax Act 1961 taxing gift in hands of recipient. It means if any gift is received now, it will be taxable under the Income Tax Act, and in the year 2017 it was amended that if any person received any gift, that will be taxable under the head income from other sources at normal rates. The provision relating to gift tax are dealt under section 56 subsection 2 clause 5 of Income Tax Act 1961. It means first it was introduced in the year 1958, then it was abolished in the year 1998, again it was introduced and included in the Income Tax Act 1961 and was amended in the year 2017, which said that if any person receives any gift, that will be taxable under the head income from other sources under the Income Tax Act 1961. Okay. Now let us understand the provision of gift tax. Okay. First is any sum of money received without consideration. It means if any person receives money as a gift without giving anything in return, then that sum of money will be taxable or not. Let's see. If the threshold limit, or we can say if the money received, that is the aggregate value, exceeds rupees 50,000, then entire sum of money will be taxable. Okay, example C. Mr. A give a gift of rupees 49,000. Okay, to Mr. B. This is exempted because it is less than 50,000. But if Mr. A give gift of 51,000 to Mr. B, then full amount of 50,000 is taxable in the hands of Mr. B under the head income from other sources. Now let us understand the next point. Any immovable property such as land, building is received without consideration. It means if any person receives gift as immovable property such as land, building without giving any money in return, then if the stamp duty value exceeds rupees 50,000, then it will be fully taxable. The entire stamp duty value will be taxable for that property. But if the stamp duty value is less than 50,000, then it will be fully exempted. Okay. Now in next case, if any immovable property is received for inadequate consideration, that is at reduced price, or immovable property is received for less than its stamp duty value. It means if any person receives gift less than its stamp duty value, then the stamp duty value exceeds the consideration paid will be the gift amount, and that gift amount, if exceeds rupees 50,000, it will be taxable. How much? Higher of rupees 50,000 or amount equal to 5% of the consideration. Okay. Now let us understand this with an example. Suppose in case 1, the stamp duty value of a land is rupees 2.5 crore, and in case 2 it is 1.7 crore. Okay, and for consideration paid in case 1 is rupees 2 crore, and in case 2 it is 1 crore. Now how much will be the gift amount in case of case 1? If the stamp duty value of the land is rupees 2.5 crore and we have paid rupees 2 crore for that land, then our gift amount will be 5 lakh. Okay, and in case 2 it will be 7 lakh because we have paid 1 crore for that land. Okay, now calculate the amount of limit, whether it will be 50,000 or 5% of the consideration. Now in case 1, if we calculate the 5% of 2 crore, then it will be 10 lakh, which is much higher than the gift amount. Okay, and also 50,000. So 10 lakh being more than 5 lakh, the entire gift amount will be exempted because the gift amount is less than 10 lakh. Okay, but in case 2 we can see, if we calculate 5% of 1 crore the consideration paid, then it will be 5 lakh. But we have received a gift of rupees 7 lakh. So here our tax free amount will be up to 5 lakh. Okay, but as we have received gift of rupees 7 lakh, so here 2 lakh will be our taxable amount, which is more than the limit, or we can say which is more than the limit we have calculated, that is the 5 lakh. So rupees 2 lakh here will be taxable. Okay, now in the third case, see, any property other than immovable property if received without consideration, like jewelry or painting or any sculptures, like any, we can say, murti. Okay, if these are received without giving any consideration, then if the aggregate fair market value of that movable property exceeds rupees 50,000, then the entire fair market value of such property will be taxable. And in fourth case, we can see if any property other than immovable property are received for a consideration. It means for that property we have given some money in return. Then the fair market value exceeding the consideration amount by 50,000 will be taxable. That is, if the fair market value is more than the consideration paid, then that excess amount will be taxable. However, the gift received from relatives such as specified in income tax rules like parents, spouse, brother, son, daughter, wife's brother or sister, husband's brother or sister, father's brother are exempted from tax. Okay. Now next is the corporate tax. It is levied on the profits made by a company from their business in India or outside India, that is whether domestic or foreign company. It means if a company earns any profit, then that will be taxable under the corporate tax. Or we can say corporate tax is a tax that is chargeable on the income of a company, whether it is situated in India, that is a domestic company, or a foreign company. Now the gains through sale of assets based in India, income earned as interest, royalties, dividend, technical service fee, all these income will be taxable under the head corporate tax at a specified rate. Now next is the capital gain tax. It is a form of direct tax that is paid due to the income that is earned from sale of assets or investment. Investment in shares, bonds, jewelry, paintings, sculptures come under the capital assets. Now what are capital assets? These are the properties which are not sold in the normal course of business, or we can say it may get connected with the business or may not be in connection with the business, or we can say it is the personal property of the business that may be in the form of shares, bond, jewelry, paintings, sculptures, and if any person sells these capital assets, and any income arising from the sale of these capital assets will be taxable under the capital gain tax. Okay.